Your mortgage rate probably sits somewhere around 6.6% today. Most people assume that number was picked by their bank or decided directly by the Federal Reserve. It wasn't. Instead, it comes from a financial market that most Americans never pay attention to, a market worth well over $150 trillion. A market so powerful that it quietly influences your mortgage, your car loan, your retirement savings, and even the stability of your job. In 2022 alone, this market caused the supposedly safe portion of millions of retirement portfolios to lose roughly 15% in a single year. The surprising part? Most people who own bonds have no idea how they actually work. By the end of this video, you'll understand exactly what bonds are, why they matter, and how every movement in the bond market affects your money. Let's start with the basics. A bond is simply a loan. When a government, corporation, or local municipality needs money, it can borrow directly from investors instead of going through a bank. You provide a fixed amount of money called the principal. In exchange, the borrower promises two things. First, they'll pay you interest at regular intervals. This is known as the coupon payment. Second, they'll return your original principal on a specific future date called the maturity date. That's it. A bond is essentially an agreement that says, loan me money today. I'll pay you interest while I use it, and I'll give your money back on a certain date. The concept itself is incredibly simple. What makes bonds important is the enormous scale at which they operate. No borrower in the world raises more money through bonds than the United States government. America's national debt now exceeds $40 trillion. The number is so massive that it's difficult to comprehend. So think about it another way. The government now spends more than $1.1 trillion every year just paying interest on that debt. Not the debt itself, just the interest. That works out to more than $3 billion every single day. In fact, interest expenses have become larger than many major government spending categories. Why should you care? Because those interest payments are ultimately funded through taxpayers, and the rates the government pays are determined by the exact same market that influences your mortgage rate. To understand everything else in this video, you only need to remember one rule. When interest rates rise, existing bond prices fall. When interest rates fall, existing bond prices rise. The two always move in opposite directions. Here's why. Imagine you purchase a bond worth $1,000 that pays 3% annually. That means you receive $30 every year. A few months later, newly issued bonds start paying 5%. Those bonds now generate $50 annually for the same $1,000 investment. If you decide to sell your older bond, buyers have a problem. Why would they pay full price for a bond paying $30 when newer bonds pay $50? They won't. To attract buyers, the price of your bond must drop. The lower price increases the effective yield and makes it competitive again. The bond itself hasn't changed. It still pays $30 annually. It still returns the full principal at maturity. But its market value falls because better alternatives now exist. This simple relationship explains nearly every major event in the bond market. Among all the bonds that exist, one matters more than almost any other. The 10-year U.S. Treasury. At the moment, it's yielding roughly 4.6%. That number influences borrowing costs throughout the entire economy. When a bank decides what mortgage rate to offer, it doesn't pull a number out of thin air. The bank starts by looking at the 10-year Treasury. Then it asks a simple question. Why would we lend money to a household for 30 years when we can lend to the U.S. government at a lower risk? To justify the additional risk, banks add a premium. That premium compensates them for possibilities such as job loss, illness, missed payments, or default. As a result, mortgage rates typically sit a couple of percentage points above Treasury yields. That's why when Treasury yields move, mortgage rates usually follow. Let's see what that means in real life. Meet Michael. Michael wants to buy a home and needs a $400,000 mortgage with a 30-year fixed rate. At a mortgage rate of roughly 6.6%, his monthly principal and interest payment comes to about $2,560. Now imagine the bond market pushes Treasury yields higher by just half a percentage point. That's not a dramatic move. It can happen within days. As Treasury yields rise, mortgage rates follow. Michael's mortgage rate increases to around 7.1%. Suddenly, his monthly payment jumps by more than $130. That may not sound life-changing. Until you realize he'll make that payment every month for the next 30 years. Over the life of the mortgage, that small move costs him nearly $50,000. Now imagine Treasury yields rise by a full percentage point. Mortgage rates climb above 7.5%. Michael's monthly payment increases by roughly $270. Over 3 decades, the additional cost approaches $100,000. Think about that for a moment. A bond yield moved by 1 percentage point. Michael never bought that bond. He never traded in that market. Yet the bond market quietly handed him a 6-figure bill. The impact becomes even more dramatic when you compare different periods in history. In early 2021, mortgage rates fell to historic lows near 2.7%. A $400,000 mortgage at those rates would have cost Michael around $1,620 per month. Just a couple of years later, mortgage rates surged above 7.8%. The exact same house. The exact same buyer. The exact same loan amount. But now the monthly payment exceeds $2,850. Nothing about the property changed. Nothing about the borrower changed. Only bond yields changed. The difference is well over $1,200 every month. Across the life of the loan, that's hundreds of thousands of dollars. No letter arrived in the mail. No invoice was sent. Yet the bond market effectively increased the cost of homeownership by nearly $500,000. That's how much influence this invisible market has over your financial life. For decades, retirement advice followed a simple formula. When you're young, invest heavily in stocks. As you get older, gradually shift more money into bonds. The logic sounded reasonable. Stocks were supposed to generate growth. Bonds were supposed to provide stability. A traditional retirement portfolio often followed a 60-40 allocation, 60% stocks and 40% bonds. The bond portion was marketed as the shock absorber, the safety net, the part of the portfolio that would help protect investors when markets became turbulent. Then came 2022. And that assumption was tested in a way most investors had never experienced. In an effort to combat inflation, the Federal Reserve launched one of the most aggressive rate hiking campaigns in decades. Interest rates moved from near zero to above 4% in less than a year. Now remember the rule we discussed earlier. When interest rates rise, bond prices fall. As rates surged higher, bond prices dropped sharply. The broad U.S. bond market suffered one of its worst years in modern history, declining roughly 13%. At the same time, the stock market also struggled, with the S&P 500 falling around 18%. Normally, bonds help offset stock market losses. But this time both asset classes were falling together. The result? The classic 60-40 portfolio lost roughly 16%. The safety cushion didn't soften the impact. It fell alongside everything else. And the damage wasn't evenly distributed. Some bond investments were hit far harder than others. The reason comes down to one of the most important concepts in bond investing: duration. Most investors never look at it. Many have never even heard of it. Yet duration determines how sensitive a bond is to changing interest rates. A simple way to think about duration is this. It estimates how much a bond or bond fund could gain or lose if interest rates move by 1 percentage point. Suppose a retired woman has $500,000 invested in a bond fund. If the fund has a duration of 6 years, a 1% increase in rates could reduce its value by approximately 6%. That translates to a loss of about $30,000. Now imagine the same retiree owns a long-term Treasury fund with a duration closer to 17 years. The exact same rate increase could produce a loss of roughly $85,000. Same investor. Same account balance. Same market move, but a dramatically different outcome. That's why duration matters so much. It often determines whether a portfolio experiences a manageable setback or a painful hit. Yet millions of investors never check it. They hear the word bond, assume safety, and stop asking questions. Another detail created confusion during the 2022 decline. Individual bonds and bond funds are not the same thing. If you buy a single bond and hold it until maturity, temporary price fluctuations don't necessarily matter. The market value may rise and fall over the years, but as long as the issuer remains solvent, you'll continue receiving interest payments and eventually get your principal back. A bond fund works differently. A bond fund never reaches maturity. Instead, it constantly buys and sells bonds while updating its value every day. When rates rise and bond prices fall, those losses appear directly in the fund's share price. And unlike a single bond, there isn't a specific maturity date that automatically restores the original value. That's why so many investors were shocked by what happened. They believed they owned a safe asset. In reality, they owned an investment whose value was highly sensitive to interest rates. Understanding that distinction is critical. Because not all bonds behave the same way. And not all safe investments carry the same level of risk. The bond market doesn't just influence retirement accounts. It also acts as an early warning system for the broader economy. Government bonds are generally viewed as the safest borrowers in the world. The U.S. government can always raise taxes or create dollars to meet its obligations. Businesses don't have that luxury. Companies can struggle. Companies can default. Companies can go bankrupt. Because of that additional risk, investors demand higher interest rates from corporations than they do from the government. The difference between those two yields is known as the credit spread. When investors feel optimistic about the economy, credit spreads tend to stay relatively small. Lenders are comfortable taking additional risk. Businesses can borrow money at favorable rates. Financial conditions remain healthy. But when investors begin worrying about economic trouble, those spreads widen. Suddenly, lenders demand more compensation before lending money to companies. The bond market starts signaling concern about slower growth, rising defaults, layoffs, and financial stress. What's fascinating is that these signals often appear before traditional economic reports reveal problems. The bond market frequently notices trouble before the headlines do. The same process happens during periods of extreme fear. When investors become nervous about recessions, banking issues, geopolitical conflicts, or financial shocks, they often move money out of risky assets and into government bonds. This behavior is commonly known as a flight to safety. Investors sell stocks. They reduce exposure to corporate debt. Then they rush into Treasury securities. As demand for Treasuries increases, bond prices rise and yields fall. Sometimes this shift happens astonishingly fast. Within days, or even hours, the bond market can completely change direction. Historically, this relationship helped balance diversified portfolios. When stocks declined, bonds often gained value. That negative correlation made diversification effective for decades. But 2022 broke that pattern. The problem wasn't a recession. The problem was rising interest rates. And higher rates put pressure on both stocks and bonds simultaneously. The very force that investors relied upon for protection became the source of the damage itself. The relationship extends even further into the stock market. Investors constantly compare potential stock returns with what they can earn from government bonds. Imagine the 10-year Treasury offers a guaranteed yield of 4.6%. Now suppose investors believe stocks might generate around 7% annually over the long term. The difference between those two numbers is known as the equity risk premium. It's the additional reward investors expect for accepting stock market uncertainty. The larger that premium becomes, the more attractive stocks appear. But when bond yields rise significantly, the gap narrows. Suddenly, investors can earn respectable returns from safer assets. As a result, some money begins flowing away from stocks and into bonds. This dynamic plays a major role in shaping market valuations. The powerful stock market rally that followed 2009 benefited enormously from exceptionally low interest rates. Bond yields were so small that investors had little choice but to seek higher returns elsewhere. Stocks became the obvious destination. When yields surged higher in 2022, that advantage disappeared. Government bonds suddenly became much more competitive. The extra reward for owning stocks shrank, and markets adjusted accordingly. Once again, everything came back to the bond market. The market most people ignore. Yet the market that quietly influences nearly every major financial decision happening around them. There is one final piece of the bond market that every investor should understand because it has one of the best track records for predicting economic slowdowns. It's called the yield curve. Despite the complicated name, the idea is simple. The yield curve is just a chart showing the interest rates paid by U.S. Treasury bonds across different time periods. On one end, you have short-term Treasury bills that mature in a few months. On the other end, you have long-term bonds that mature decades from now. Under normal conditions, longer-term bonds pay higher yields than shorter-term bonds. And that makes perfect sense. If you're locking up money for 30 years instead of 3 months, you expect a higher return for taking on that extra uncertainty. As a result, the yield curve normally slopes upward. But occasionally something unusual happens. Short-term yields rise above long-term yields. This is known as an inverted yield curve. And when it appears, the bond market is sending a very specific message. Investors believe economic growth is likely to weaken in the future. They expect the Federal Reserve to eventually cut interest rates to support the economy. In other words, the bond market starts pricing in a slowdown before most people even realize one may be coming. What's remarkable is how accurate this signal has been historically. Every U.S. recession over the past several decades was preceded by an inverted yield curve. No indicator is perfect, but few economic signals have a track record that comes close. When the yield curve inverts, Wall Street pays attention. Because the bond market isn't guessing. It's putting trillions of dollars behind its prediction. And that's why many professional investors watch bond yields more closely than economic headlines. The bond market often sees changes coming before everyone else. But bonds don't only affect mortgages, retirement accounts, and recession forecasts. They also influence something much closer to home. Your savings. Most people assume cash sitting in a traditional savings account is doing its job. The problem is that many large banks pay extremely low interest rates on deposits. In some cases, balances earn less than half of 1% annually. Meanwhile, short-term Treasury bills frequently offer several times that amount. Both options are considered extremely safe, yet one may generate dramatically more income than the other. Imagine Jennifer keeps $50,000 in a traditional savings account earning 0.4%. That money produces only about $200 in annual interest. Now imagine the same $50,000 is placed into short-term Treasury bills yielding around 3.8%. Suddenly the annual income jumps to approximately $1,900. Same money. Similar safety. Completely different result. Over several years, that gap can add up to thousands of dollars that many savers simply leave on the table. And most never realize it. The reason isn't risk. The reason is habit. People often leave money where it's always been instead of checking whether a better option exists. The bond market quietly rewards those who pay attention. And that leads to one final lesson. If inflation is one of your biggest concerns, the U.S. Treasury also offers inflation-linked savings products designed to help preserve purchasing power. These securities adjust based on inflation and can provide a useful tool for savers who want protection from rising prices. They won't make anyone rich overnight, but they can help prevent cash from losing value over time. Now let's step back and look at the bigger picture. The bond market isn't some obscure corner of finance reserved for economists and institutional investors. It's the engine operating behind nearly every major financial decision in the economy. When bond yields rise, mortgages become more expensive. Car loans become more expensive. Corporate borrowing becomes more expensive. Business expansion slows. Consumer spending weakens. And economic growth often follows. When bond yields fall, the opposite happens. Borrowing becomes easier. Businesses invest more. Consumers spend more. Economic activity accelerates. That's why bond yields are often called the economy's heartbeat. They reveal how investors collectively view inflation, growth, risk, and the future. And unlike opinions, forecasts, or headlines, those views are backed by trillions of dollars. The bond market influences your mortgage payment, your retirement account, your savings, your investment returns, even the job market your employer operates in. Whether you participate in it or not, it affects your financial life every single day. The people who understand bonds aren't necessarily smarter. They simply understand the system that quietly determines the cost of money. And once you understand that system, financial headlines start making a lot more sense. Because behind almost every major economic story, you'll usually find the same thing pulling the strings. The bond market. Invisible to most people, but impacting nearly everyone. The bond market may seem complicated, but the bigger lesson is simple. The more you understand money, the less money controls you. Wealth isn't built through shortcuts. It's built through knowledge, patience, and consistent investing over time. Every book you read, every financial concept you learn, and every smart investment decision you make is another step toward financial freedom. So if you're serious about growing your wealth and becoming a better investor, subscribe to the channel and join us for the next deep dive. Thank you for watching, and remember, your future wealth is determined by the financial decisions you make today. I'll see you in the next one.